Good evening. Welcome to We Mean Business. I'm Manisha Nair Dhawan. India's current account deficit in the third quarter has come in at a record-breaking 6.7% versus the 5.4% seen in the second quarter. This could take the current account deficit for the entire year higher than the 5% which is expected, which is definitely beyond the comfort zone of a developing country like ours. Is this situation alarming? What can be done to manage the situation, and what steps need to be taken to shrink the current account deficit? To discuss this, I am joined by Rupa Rege Nitsure. She is a Chief Economist and General Manager at Bank of Baroda. We also have with us Mr. S Venkatesh, Chief General Manager and Head Treasury at IDBI Bank. We've got Dr Brinda Jagirdar, she's a business economist. Dr Arbind Prasad, Director General at FICCI. We've got Mr. M K Venu, Managing Editor, Financial Express, joining us in Delhi. And we've got Mr. Vikram Singh Mehta, former Chairman of Shell Group of Companies, also joining us from Delhi. Before we start the discussion, Ira Dugal joins us to take us through the fine print of the third quarter current account data released by the RBI.
No relief in the external sector. The current account deficit data released for the third quarter, that's the December quarter, showing that the current account deficit has widened to yet another record high. 6.7% of GDP is where the current account deficit stood in the third quarter of the fiscal year versus 5.4% in the second quarter. The market was already expecting an ugly number, anywhere between 6 and 6.5%, so the 6.7% is higher than that. Even in absolute terms, the current account deficit is worse than what the market was expecting. Current account deficit came in at $32.6 billion. The expectation was somewhere between 28 to 31. 31 was the upper range of estimates, so this has been higher than that as well. The April to December CAD also naturally looks extremely uncomfortable at 5.4% of GDP, and all of these are record highs. What is actually a silver lining in all of this is the capital flows picture. The inflows on the financial account, strong surge in capital flows has meant that the current account deficit, despite being at a record high, has been fully financed. So portfolio flows played a large part in that, and say $8.6 billion is what you drew in portfolio flows in the third quarter, and that's one major reason why you've actually been fully financed despite the record high CAD. FDI flows were not particularly encouraging, just came in at $2.5 billion. Net invisibles also moderated, so all of that was part of the external sector picture. But net, there was an accretion to forex reserves in BOP terms at just about $0.8 billion, but still an accretion, which is again a slight silver lining in an otherwise bad data point. On the trade account, Q3 trade deficit stood at $59.6 billion. Exports were up a marginal 0.5% in BOP terms. Imports were up 9.4% to $131.4 billion in BOP terms. And the RBI says that this is largely on account of oil and gold. So as you look ahead, because this is backward-looking data, the judgment that you need to make is how quickly will gold imports come down in the next fiscal, because oil imports tend to be relatively inelastic, and only if you expect a steep fall in gold imports can you say that the current account picture will improve drastically from here on, and of course if the base, the GDP actually increases. But this is not a comfortable number. The currency markets in particular could see a slight knee-jerk negative reaction when they open on Monday.
Thanks for that breakdown and analysis, Ira. Let's get this discussion started. Mr. Mehta, the current account deficit for the third quarter has come in at a record-breaking number, but a bad number was expected. And of course, the silver lining that's completely fully financed. If it is fully financed, should we worry that much?
Yes, we have to worry for various reasons. First, growth is slowing down, and notwithstanding that, our current account deficit is at a record high. The reasons have already been spelled out. Gold and oil are the main factors, but over and above that, we have also, in a sense, created the problem for ourselves. We have now stopped exporting iron ore. We are importing steel. We are unable to develop indigenous coal, so we are importing coal. Our export markets are sluggish, so notwithstanding the depreciation of the rupee, we're unable to actually take advantage of this price benefit because of the slowdown in Europe and in America. So there are huge worries. The fact that the current account deficit has been fully financed is also perhaps a cause for worry. You have to ask yourself, what is the nature of this financing? Is this hot money, or is this indeed money that's going to stay in the country. I don't know all the facts, but I wouldn't be surprised if a large part of the portfolio financing is fickle, in that if there is a change in the market sentiment, this money could reverse and go back out again. So all in all, I think the current account deficit is a very serious cause for concern. It reflects not just the weakness of our macroeconomy, it also in some senses reflects the fact that the combination of slow growth and scams have in many respects impacted the external balance of payments position. And this will in turn, of course, impact growth and inflation. So I'm still very concerned.